Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money, millennials, and the young at heart. Welcome world to yet another episode of Manage Your Damn Money with Ben and Malcolm. My friend Malcolm Ethridge and co-host of this show. How are you doing? And now that we've arrived in 2020?
Honestly, New Year, same me. If I may, I'm glad that we had that little bit of a layover and a little bit of a break, transitioning, but frankly, I didn't use it right. So
Indeed. Well, this is a pretty interesting, amazing moment for us. This marks season 5 of Manage Your Damn Money in its current iteration with you and I.
It's been a long time coming.
Been a long road. So this is our first episode in 2020, man. So hopefully we'll be able to give the people some more fresh fare around money and personal finances. This particular episode, we're talking about the nitty-gritty details behind improving your credit score. And we actually have a guest for this show who goes by the name of Momodou Mambouray. He's the CEO of Max Credit Score. But before we get into that whole conversation, as we do on every show, it is now time for headlines. I tried Kakeibo, the Japanese art of saving money, and it completely changed how I spend my money. This is a January 2020 piece on CNBC.com by Sarah Harvey, not to be confused with Lori Harvey. After living in Tokyo for 6 months, I became fascinated by how small details, mindfulness, and incremental changes were given more emphasis in Japanese daily life. I had a habit of shopping when I felt bored, stressed, or unhappy about something. I also shopped when I was in a good or celebratory mood with a tendency to go beyond my means. While I've never gotten into serious debt, I always knew I needed to put more effort into making smarter financial decisions. But as many people would agree, this isn't easy to do, partly because our spending habits are deeply cemented into our daily routine, and the act of spending also includes an emotional aspect, Malcolm. So do you know what Kakeibo is?
Never heard of it.
Never heard of it? This was actually my first time seeing it.
I thought it was a typo when I picked up the script.
So. Okay, indeed. Well, it goes on to say, then I learned about the Japanese practice of Kakeibo, pronounced Kakeibo, which translates as household financial ledger, invented in 1904 by a woman named Hani Motoko, notable for being Japan's first female journalist. Kakeibo is a simple, no-frills approach to managing your finances. Like all budgeting systems, the idea behind Kakeibo is to help you understand your relationship with the money by keeping a ledger of everything that is incoming and outgoing. What sets this 116-year-old method apart, however, is that it doesn't involve any budgeting software, Malcolm, which I'm sure we've talked about on this show many a times.
Right.
Apps or Excel spreadsheets. It's kind of like Sans, the technology. Sans.
I don't want to do that on the record.
Okay. I've been paying attention and I learned on this show myself. And then what does it say? Similar to the bullet journaling, Kakeibo emphasizes the importance of physically writing down as a meditative way to process and observe your spending habits, Malcolm. Research has proven again and again the numerous benefits of writing by hand. It can help you make positive changes by encouraging you to be more present and aware, while also acknowledging the triggers of your spending habits or other habits that you have around your money. Any reactions to a technology-less budgeting, Malcolm?
So for one, you're not going to get me to stop using Excel. That's first and foremost. But for two, as much as I want to dismiss it and the kind of hokiness of some of it and the touchy-feely nature of it, I have to keep in mind that whatever it is that helps you get there, by all means do that thing.
Go ahead and try it.
Right? I don't want to knock it in the sense that folks are actually trying to get control of their finances and hold themselves accountable.
Right.
But when you start talking about mindfulness, meditation, and using terms like bullet journaling, which I think also is some crap, it's tough for me to not immediately dismiss it, but I get the sentiment where you're trying to get to.
I think the California in me, this kind of connected with me.
That hokiness, see, that's what I'm talking about.
Is it hokiness or? Well, to me, what struck with me was the practice of actually writing it down. Because it's like this. If you're about to go buy, like for me, my, I guess, small vice is Red Bull, especially right now with my life.
Okay. That sounds like a necessity, but okay.
Right. But I would have to think literally, is this the time that I need it? Because then I'm going to have to go and write it down in my journal. Like, and that might actually prevent me from spending. So the labor
of having to write it down is enough to deter you from spending the money.
In my mind, that actually could be the most helpful component of this.
That's a good, okay.
Because then you're like, I don't feel like doing that, so I'm not buying it.
Maybe Californians aren't all sandals and avocados then. Maybe, my bad.
Indeed. Writing down spending and income has a tendency of slowing down and having you think about what you're about to write. How could such a practice, even if modified, help adjust our spending for the better, Malcolm?
So like I said, I use Excel for like basically everything. Mm-hmm. And so I actually have an Excel spreadsheet that on the weekends I'll pull up like all the different cards we use and where money has gone out.
This is a weekend fair for you. Oh my God.
Yeah, like Saturday morning I get up, I don't have anything to do. I like to multitask while I watch TV. This is one of my activities that I'll do, like to stay on top of it. Because I have an expectation in my mind of what I should spend for the month. Okay. And that then translates to weekly. Okay. And so I got to make sure that I'm like actually on track, because Wednesday comes, it's lunchtime, and I say, I kind of want to go to Panera, but I shouldn't because I'm already over because I blew the doors off of it last week. So that kind of stuff kind of helps keep me in check.
I feel like your future kids are going to be super mad. Like, Dad, stop looking at the budget.
Good luck to them. I've got a running tally at this point.
Indeed. Well, I want to remind people, as always, they can catch past episodes of Manage Your Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a review on any of those platforms. That helps more people catch the show. If you have a question for us or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. You can always catch us on the gram or on Twitter. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And you can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm. In 2020, you may have a number of the following items on your list of to-dos: buy a car, buy a house, rent a new apartment, open a new credit card, refinance a mortgage, get started on funding your business. There's one thing that stands as the gatekeeper between you and all of the things I just mentioned. It's your credit score.
Oh, no.
That mysterious number that seems to materialize out of thin air is the bridge between you and better terms to whatever credit-based product you're in the market for. In this episode of Manage Your Damn Money, we're taking a look at the specifics behind how to improve your credit score, Malcolm, in this new year. So First question for you, just very basically, what's a credit score? No, wait. If you don't know what a credit score is, first, people should go back and listen to it.
That was the first thing I was going to say, too.
It's 100 episodes.
Beat me to it.
Right. It's 100 episodes to manage their money.
We've probably done 2 or 3, I think.
Certainly.
On credit scores and understanding all those pieces.
Right.
So I guess succinctly, I'll say it's that number that determines whether you get approved or not.
Right.
And then how much you pay to borrow money.
Right, indeed. And because we believe in not leaving any child left behind here on Manage Their Money.
Speak for yourself.
A credit score is a statistical number that evaluates a consumer's creditworthiness and is based on credit history. Lenders use credit scores to evaluate the probability that an individual will repay his or her debts. A person's credit score can range from 300 to 850, and the higher the score, the more financially trustworthy a person is considered to be. And that comes to us, that definition, by our favorite website, Investopedia. So credit score basics, also by Investopedia.com. The credit score model was created by the Fair Isaacs Corporation, also known as FICO, and is used by financial institutions. Consumers can possess high scores by maintaining a long history of paying their bills on time and keeping their debt or total debt low. So Malcolm, question for you. In terms of raw numbers, how do excellent credit scores put you in a better position than a poor credit score? What advantage does it give you?
Well, frankly, the way that a lot of credit card reward systems are built today, they're really built on the backs of folks with poorer credit scores. So the folks that are paying 20+% interest on a regular basis on outstanding balances, they're paying for the rewards, the airline travel, the free Uber rides and all that stuff that folks who have the top tier credit are using on those credit cards.
I see.
Because those are people who typically have a habit of paying off the balance at the end of the month anyway.
Right.
And they're really only using the card to get access to those ridiculous rewards.
Right.
And so the higher your score, the better tier stuff you qualify for.
Right.
But also the lower your score, the higher your interest rate,
Right.
you carry that balance and you're paying for other people to have fun, basically.
So and essentially not only that, things become more expensive to you personally.
Very much
The
so.
poorer your credit score. For instance, if you have a poor credit score, you go to the car dealership, you can't get a good deal on the car because your credit score is so low, you're going to get higher interest rates, which pumps up the monthly cost of paying for the car.
Right. So at about 760 is the threshold to get the good version of much of anything.
Okay.
And so if you go to that same car dealership in your example and you're applying for an auto loan and you've got a 761, you're going to get that dealership's best financing offer that they have to give you. So say the going rate is 3 or 4%.
Okay.
If you're a person who's just shy of that, say 720, you'll get somewhere tiered in the middle and maybe they have you at 5 or 6. But when you get into the, I think it's 640 and below range, you become what they call subprime. And that's where you start to really pay. And you're now in the double digits in some cases on that same auto loan. It could take you an extra 2 years to pay off that same car that a person with the 761 is going to pay for.
Indeed, indeed. And more on that, credit score plays a key role in a lender's decision to offer credit. People with credit scores below 640, as Malcolm mentioned, are generally considered to be subprime borrowers. Lending institutions often charge interest on subprime mortgages at a rate higher than a conventional mortgage in order to compensate themselves for carrying more risk and the risk attached to lending to you as a poor lending person. They also may require a shorter repayment term or a co-signer for borrowers with lower credit scores. Conversely, a credit score of 700 or above is generally considered good and may result in a borrower receiving a lower interest rate, which results in them paying less money in the interest over the life of the loan. And here are the factors, Malcolm, to what generally factors into how you get a score. It's payment history. It's the total amount of outstanding debt that you owe. It's also the length of the history. So my first credit card I think I opened when I was maybe 18. So that one's still open.
The earliest you're legally allowed to.
Absolutely.
Yeah.
They try to close it all the time because I don't use it at all. I go buy a stick of gum. I'm like, nah, you keeping that open. And then also types of credit that you have, and then the new lines of credit that you open, Malcolm. So a couple quick questions before we get further into it. The methods by which to improve your score, at least for me, and through my experience with the personal finance space, always seems to be shrouded in some level of secrecy. It's not truly clear what does what. There's 3 different credit bureaus, and one score might be here with one bureau, another score might be there with another. Why don't we know from credit bureaus in particular exactly how scores are determined?
My assumption is just that if I gave you the secret sauce, you would have no reason to pay me to keep your score, right? Like these companies like Equifax, Experian, TransUnion actually have their own services now that you can subscribe to on a monthly basis to get access to your score and your credit report and keep track of how. If I give you the formula, you know how to work the system, and you no longer have to come to me to get access and make sure that you're on target. That's my assumption. I don't think a whole lot of wizardry really goes into it beyond that. But also, by not telling you what the rules are, it allows me to change them as frequently as I need to. So like there's something now called a Vantage score that's different from FICO that some lenders actually use. And I think they're up to like iteration number 8 at some point. It incorporates more data supposedly than the FICO does. But like by not giving you what the scoring to Vantage score 3.0 was, I could create 8.0 and not have to inform you along the way what actually makes a difference. Or what data we're collecting on you, that kind of stuff.
Indeed. And I think it should be noted really quickly that your social security number is attached to your credit score.
Unfortunately.
Yeah, unfortunately. That's a huge issue that we've discussed on the show before. Social security numbers weren't intended to be used as tags for your credit score.
They also weren't intended for Equifax to give away to the public, but we are where we are.
With password 1 as the password to their database. But anyway, is there a reason for keeping the public in the dark about the exact credit score equation?
Like I said, the secrecy just kind of allows them to maneuver however they want to and not have to be accountable to us. Like you said, the rule was X. I did X, and now you're telling me it's, whatever. They can change it all they want.
Indeed. Well, some basic tenets of improving and maintaining your credit score. Really quickly, Malcolm, and this comes from Investopedia, review your credit reports and dispute problems on the report. So a full credit report, credit score is one thing, but you can also request a full credit report, which shows all the different line items, all the different pieces of debt that you have, all the things that are outstanding, all the former, credit lines you may have had opened and closed, blah, 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 blah. It tells you everything. That's a full report. Then also get a handle on your bill payments. A really strong tenet that I've always heard of since I can remember is aim for a 30% credit utilization or lower. And what's that mean exactly?
So essentially, of all of the revolving debt that you have available to you, so all of your combined credit cards, for example, that are available, you've got $50,000 total that you can borrow. 30% of that is what you want to target as far as your utilization was at 15,000 on 50,000. I think that's 30%.
So that would be your total balance against all the rest of. Okay, very good. And also limit requests for new credit and hard inquiries. I think this is a big deal. I used to work at Banana Republic. I used to always feel guilty about asking people to open the banana card because like I knew that wasn't a good thing at the time. Like you don't need this 30% interest rate store card
just to get $8 off these slacks.
I got some like reward on the back end for opening credit cards.
I'm kind of surprised that still exists.
I don't know if it does now.
Oh, I was just in Target and they asked me, did I want a Target red card? And I was like, for the 83,000th time, no.
No, thank you. Indeed. And then the difference between, and then a hard inquiry. What's a hard inquiry?
Essentially, it's an inquiry that shows up on your actual credit file. Like they've got to pull the entire file and it shows up as one of those dings that you just talked about.
Right. And a hard inquiry usually is for like car loans, mortgages, really big things. There's other things that are a little bit what are called soft inquiries as well.
Maybe when you go to get insurance or a cell phone and things like that.
They don't see your whole report. It's just maybe like a little flash in the pan. And then also make the most of a thin credit file. An estimated 62 million Americans have this problem. Fortunately, there are always ways you can fatten up a thin credit file and earn a good credit score. There are programs you can enroll with to help start you off. You got to do some research, and we may have talked about that on a previous show in terms of how to deal with that when you don't have a credit score. You have like not enough to create a credit score.
We did. Glad to see you were paying attention.
Indeed, I was. And then also keep old accounts open and deal with delinquencies. I know I just said I have a credit card that I've had since I was 18. I'm 32. That long, time of that credit history plays to my benefit. And then also, when necessary, use free credit monitoring services, which and a lot of times are now coming with like credit cards themselves, right?
Mm-hmm. Well, I mean, yes and no. They're all pulling from the same place.
Right.
So like I said, like the Vantage score that everybody, or a lot of people use now, it's mostly credit card companies.
Right.
So if you have like 3 separate credit cards and they all offer you free credit monitoring, quote unquote,
Right.
it's pulling it from the exact same place.
Right.
But yes, to your point, like you can pretty much get it anywhere at this point.
For sure, for sure. Well, we're going to get deep into this a little bit further with a guest that we have on today's show on the other side of this music break. He goes by the name of Momodou Mambouray. He's the CEO of Max Credit Score. We're going to talk to him about the other details of how to make sure that your credit score is in its optimal position for 2020. But before we do that, as I always say, I'd like to remind you to listen to past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Of course, if you could please do us a favor, leave us a rating and a review on any of those platforms. That helps more people catch the show.
A good review, by the way.
Oh yeah, that's a requirement,
Yeah.
a good review. Don't do any of those like other kinds of reviews. Also, if you have a question or a topic you want us to cover, info@manageyourdamnmoney.com. And of course, you can follow us on social media, Instagram and Twitter. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And of course, you can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm. Where on this episode, we're covering the nitty-gritty details behind improving your credit score. And we are joined at the desk on this episode by Mr. Momodou Mambouray. He's the CEO of Max Credit Score. As the CEO of Max Credit Score, Momodou helps individuals and commercial businesses to achieve their credit, financing, and funding goals through one-on-one consulting. Sir, welcome to the show.
Thank you very much. Glad to be here.
Indeed.
Glad to be here, my old friend.
I want to get one thing on the record. So I've known you basically your whole life.
This is true.
Your daddy call you Mo, I'ma call you Mo.
Well,
So, suddenly we became adults and you became Momodou. And I just want to,
Since I'm on your stage, I'll respect that line. Okay. And I'll stick with Mo from there on.
I'm kind of confused because this is Malcolm's friend, so I guess I have to say Mo.
He's
now.
butchered my name half of his life. That's what he really meant to say.
That's probably true.
Indeed,
That's probably true.
Well, real quickly, tell us about your work and how you got started in counseling people on their credit.
Awesome. Yeah, I mean, credit counseling is something that's not just very important to folks that are in underprivileged communities, it's kind of something that could be your superpower as well as the big elephant in the room if you don't know sort of how it works in. So my falling with getting into the business, it kind of was a blessing to me in disguise. I was a lender previously. I also work with Wells Fargo Financial as a financial advisor. I've been in and out of the banks pretty much since high school. You know, finance graduate, master's, no class on credit. So after a while in real estate, I was able to help several of my clients close on their homes by helping them improve their scores. Then I saw the people person in me kind of always gravitated to those conversations. So I did pretty well, but I would spend more time on counseling people than I did on closing deals that were ready. So also at that time, I wanted to get away from the finance industry and kind of go into entrepreneurship. And I said a very, very deep, I would say, prayer about it. And then everything went south. Wells Fargo got into a little trouble because of some lending practices, and that was my way to kind of get into the industry. And when it happened, it just changed my life. I helped my parents save their home at the time, helped my brother and his wife, who had a new kid at the time, get their first property. So the rest was pretty much just history.
Okay. Interesting. So it sounds like it was an entrepreneurial effort that dovetailed from some of your professional and the traditional career track. Let me ask you this. How did you convince your first few clients you were worth their time and their money?
So emotional intelligence goes a long way. If you come from a sales background, you understand no one likes to be sold. Right. So it took less convincing and more of just showing to prove. Okay. So I started with letting close friends of mine kind of witness what I would do for other clients before I would even ever solicit to them that I did that. So after watching a few people buy a house, and I worked with Malcolm's mother in the past also, and he's one of those who never had any shame to just be like, hey, I understand this, but I could understand it a little more. So after the 100, 200 person got their credit scores above a 700, everyone else kind of just perked their ears up a little bit.
Okay, very good, very good.
So I know that sort of the conversation we had slated to questions we had to throw at you for this are a little bit more geared toward like credit reporting in general and ways to tactically go about enhancing your score. But to take one big step back, just give us a little bit of an idea, the difference between credit counseling, and then you have some folks that do consolidation work, and then you guys that I know actually on behalf of the clients will work to improve their score, and kind of give us the lay of the land.
Absolutely. So we do a full service program to where we not only clean up the client's credit profile and start to dispute the negative items, but we actually add positive credit cards for them with their approval, and we teach them how to use it on a monthly basis. And we get a lot of success that way because when you leave it on the client's hands, most other companies kind of show them a blueprint to follow, to which, if you had the vested interest to fix your credit, it's one thing to do it on your own. It's another to trust a professional to do it. So one thing that makes ours work that combines credit counseling and credit repair is that we take it off of their hands.
So
now,
stay on that for a second. Why is it a good thing to add credit cards to a person's profile if they're coming to you to ask for help?
Good question. So you all touched on the FICO scoring model, which of course allots a certain amount of your credit profile and score to how you use credit cards. And credit cards actually drive 65% of your credit score every month because not only do you have to pay it on time and get that 35% credit for payment history, you also have to maintain and manage your balances under 30% to get that revolving debt ratio category. So it's important for the client to know that when you're cleaning your report up, you're only taking stress out of that payment history category for 35%. You have to have consistent activity on making those payments on time, and that's what actually boosts the score up. So when people get scared of credit cards, they shy away from it, but you actually need credit to build credit.
And then Malcolm also mentioned the credit consolidation component. Talk a little bit about that.
So debt consolidation overall is something that people offer as a service. They don't always link it to credit. If you have a lot of credit card debt or open debts on your credit report, you want to do a debt consolidation because not only will those third-party companies negotiate to lower those debts, they will also do a weighted average interest rate of all the debts that you have. And instead of one large interest rate, you'll play something a little smaller. Now, there are pros and cons to it, though, because that will reduce your debt, but they're not actually going to pay it in accordance to it helping your credit score. So when you look at your overall amount of credit card debt and you look at that debt ratio, yes, it's a matter of the total amount of debt, but each individual credit card has to be under 30% to get that major boost to your score. So if you have 5, 6 credit cards over 30%, little do you know, as soon as you bring even the smallest one under that 30% marker, that's going to create a big boost to your score. So when you're doing debt consolidation, you might have 5 debts that they're tackling, and they're putting $200 to each debt instead of aggressively paying down the one with the highest interest rate, which would save you money over time because debt gets expensive, or focusing on the card with the lowest limit, which can get under that range.
Indeed. Another question, you've been talking about some of the elements of how to do it and the tactics behind it. What are some of the components that people misunderstand about kind of raising their credit score, rehabbing their credit score, something that people think is the case, but maybe it's not, or it's different than what they assume?
Yeah, so in general, remember, it's based on your monthly activities. For example, many people get confused when you pay your house note off, your credit score drops. You pay your car note off, your credit score drops.
And
they're
people
wondering
wonder why.
Exactly, because you just paid something off, right? But once you clear a debt, that monthly activity of showing that on-time payment disappears. So initially, it looks like your score is going to drop, but 2-3 months down the line, it's going to increase. Same to where when you first get a debt on your profile. If you buy a house, immediately you have $300,000-$400,000 coming on your credit report, it's going to drop the score a bit. But once you start some on-time payments, it'll actually start to boost the score. So you always want to look at what monthly activity you have going that's actually working for you.
Okay, indeed. Now, kind of changing positions a little bit, we've kind of touched on it before on the show, but briefly, what does a credit score improvement scam look like? We're in the Instagram age where there are a lot of people who, put themselves out to be credit improvement service people, whatever that means. How do you
Credit Eastas.
So
how do you know the difference between you and your service and somebody else who, if I don't know the difference between the two?
Gotcha. Now, as a rule of thumb in my company with my team, we always make sure we don't company bash, because it's not that these companies are scams or anything, they just have a different function. For example, some of the larger companies will just work to clean up your credit profile. But when you clean up your report also, if you don't follow up on those items for 3 months consecutively, those companies do have a right to appeal. So they can wait 6 months from now, 2 years from now, sell it dirt cheap to a different collection agency and slap it right back on your report. So if you don't know about that permanent deletion process, you might think someone scammed you when they were just trying to clean your report up. Then it's a method to adding the right credit cards to then come on the higher tier cards, because when your scores are low at first, you're only going to qualify for those no annual fee, high interest rate cards. Then, as he mentioned, the trade-off for that is for the people who do pay their balances in full, the companies don't get to make that much interest on you, but at the same time, everyone else is paying for it because they're usually borrowing it at the very high interest rate.
Indeed.
So you said, and you should be a politician. That was a really good answer.
I was going to say, he's up here just talking.
Because, I'll be frank, some people are scammers. Like, let's call a thing. But I'll take your way of looking at it. Your glass
put it
half
this way,
full.
you have many companies that follow the residual income model. So they are more so focused on getting many different credit repair agents and then recruiting others to come in, sort of like a multi-level
So
marketing.
it's a pyramid scheme.
Multi-level marketing.
Man, you're such a good politician.
It's called diplomacy, Malcolm.
It's called, you would call it a pyramid scheme, but every business's structure and format can look schemy, right? But if you are dealing with a company where their function is to get recruits, not to fix your score, you're probably not dealing with a credit repair expert. You're dealing with someone who might have good sales skills and be able to tell you what you could, you can retire and make $100,000 a month residual income, which isn't very realistic all the time, but for that reason, they do misinform people, so that other term you could condone. But I always like to say, again, the more informed you are on what it takes to actually boost the score and just put your focus to that, the more success you're going to have in general.
Congressman Mambouray,
I
have another question.
I wouldn't be surprised.
I have another question for you. What scenarios, we've been talking about like the tactics and everything else about kind of the credit score side, but I want to talk about the people. What kind of person or what kind of scenarios lend themselves to hiring someone like yourself?
So, and this is one that I would kind of just like to debunk a lot of things around, because folks think a lot of times people are under the impression if your credit score is bad, that means your life is terrible, you don't manage your finances right, you're not making money. And I always, just to put it in perspective for them, when I have clients that don't have more than $5,000, $10,000 of debt and they're stressed out, the clients who have real issues are the ones who are still dealing with foreclosures from the crisis that happened back in the 90s. So you are looking at a situation where if you have anything less than $20,000 worth of debt, there's no reason why if you don't follow our formula, you can literally boost your scores to a 700 within 6 months, no matter where you're starting from. If you have higher debts that you have to deal with, then yes, it might take some cash to sort of pay those down. But I would encourage everyone to at least reach out and get the information that it takes, because many times it's not even about jumping into the credit repair process. If you know how your FICO scores work, you're less likely to go into a store and swipe for something that you know that's going to affect you in the long run. Right. So I always just try to focus on that education piece. That's why we do the free home buyer seminars with your DMV team, Coalition Properties, and other groups, is because we just find that when we teach the public everything they need to know, if they need the service, they'll come find you. So in honesty, most of our business comes from referral agents and credit and real estate companies, loan officers. So we never actually have to solicit for the business. Not that we don't need it, but it's a better formula to where we can just focus on the education piece.
Indeed, indeed. So you are in credit enhancement and improvement service area. Are you willing to tell us your credit score?
Yeah, absolutely. So I fluctuate between the 770s and the 800s, only because I use a large amount of debt. I mean, born and raised in West Africa, I still have a lot of family over there I kind of got to take care of. So every month, folks are hitting me up for different sort of things. But, don't get caught up in trying to have the perfect 800 score. Get caught up in making sure you're managing your debts right, and more importantly, whenever you finance something, you're not being charged high interest rates on it. Because often, if the average person goes out to purchase something on credit, they will need a car, they need a car. They're not thinking about the interest rate, even if the payment's gonna be $480, they just kind of want it. But if you show them what they threw away on interest for 6 months, then their eyes raise a little bit like, okay, I can do different. And anybody over a 650 credit score, you can refinance and get those lower interest rates if you know the particular institution is gonna allow you to do that. So, information is everything in this case.
You touched on it. You said yours fluctuates between 700 and 800. I was going to add, my next question was, is an 800 score even really possible?
Absolutely.
How do you get to that?
So the difference, people plateau in the 600s because they make their payments on time in most cases, but they never maintain their credit card balances under 30% consistently, and they don't have a good mix of accounts. So you always want to try to have at least 2 bank credit cards, one retail account, and 1 installment account, something like a car note, mortgage payment, student loan. Once you get into the 700s, by making sure you have the good mix and you're staying under 30%, 800s, they don't want to see any late payments, derogatory information in the last 2.5, almost 3 years. So that's really what's the difference maker is. And then they want to see that you've paid off a couple installment debts in full over time, showing that you have that good 7 to 10 years of good history. So I often tell people, a good way to enhance your history is to get an authorized user on your credit card if you know it's somebody you trust, but that's an artificial way to inflate your credit score. That's the first thing that popped in my mind when you said folks are out there scamming people, is because not that they're scamming them, but they'll give them that quick fix like, hey, put some trade lines on your credit report, get an authorized user and you'll be fine. But that's you resting on someone else's credit history to where if they mess it up, now you're at mercy. You don't have anything that you've built solid on yourself.
So 2 quick ones real quick. So I know, because you and I have talked about this in the past, I can't tell you how many times I've taken credit for things you've told me as if they were my own ideas. So thank you, by the way. But so you've told me in the past that 30% isn't really the threshold that you want to shoot for, even though it's kind of the number that we have in our minds. I recently saw a piece that the Wall Street Journal did where they basically said, like, the closer you get to 30%, things start falling apart. And then once you hit that 30% threshold, that's when it kind of falls off a cliff. Could you talk a little bit about the difference between that 10% utilization number and 30%, or if there's a different threshold?
Well, not really a different threshold. You want to stay under the 30% range because it allows your credit cards to grow. So what you don't know is as soon as you spend over 30%, the banks will put a temporary freeze on how fast that limit grows. So now a $1,000 card 2 years later can be just $1,500 or $2,000, to where if you would have stayed consistently under 30%, it would have grew in the long run. But you're talking about maybe a different client than somebody who has a business. Now that 30% rule I give to clients because for the average person, it'll keep you responsible to make sure you don't take on debt you can't afford to pay back. However, say you're a business owner and you have a $10,000 credit card, and every month you spend a lot of money to get products for your business, and you spent $9,000 and then you pay it right off within that 30-day marker, that'll actually boost your score and grow your limit even faster. But if you shared that information to the public as the common knowledge, then folks are going to say, okay, let me max it out, and then they're stuck with a credit card. So I try to temper myself depending on which group I'm teaching in terms of just which options to tell them to exercise and what things they need to stay away from.
So a separate one I had real quick. I know, like, for you guys, the way your model works is, yes, the education component is there, but you also take on not the responsibility, but the work on behalf of the client in repairing their file and their score. Aside from some of the metrics that you gave us, like the utilization and that ratio between bank cards and store cards and that kind of thing, is there anything else in there that's sort of like a rule of thumb that you guys utilize on behalf of the clients that you work with?
Well, on the dispute side, I have these wonderful ladies that work with me. My team of dispute engineers, all of them are former underwriters, half of them are attorneys. So they just have just a master's in scrutiny, if you will. So you'd be surprised how often things are reported incorrectly, and especially when companies are buying and selling these debts, even when it comes to the student loan department, for example. They make a lot of mistakes on those ends. And the law does provide some coverage for you to where they have to make sure they adhere to that. So what we do really isn't rocket science. I could teach the average individual how to fix their credit through the dispute letter process, but it's several methods to go into it, a certain legal language that you need to know.
Sounds like it takes a lot of work.
It takes a lot of work. It's very, folks think I kind of make it look easy because I'm just like, hey, here are these results. But behind the scenes, it takes a lot of work. And that's why it's a good service for the client who doesn't want to write up 5, 6, 7 different letters to one bureau every single month, send it, wait for the return to come and understand all the legal documentation. So on one end for the dispute process, that's really what it is just about cleaning the report up and knowing the right legal information to put in there. On the credit repair, on the credit building process, when it comes to using the credit cards, it's as simple as just following up on good momentum. So my clients see results every 35 days. Whenever we pull their report up, we see 7 items have been deleted, 5 items have been deleted, you've saved $3,000 on collections. That might give us a small score boost, which we're going to follow up and add the first tier credit card. Tell you how to use that for 3-4 months, repeat the same cycle, add on another credit card, and keep proceeding. So it's really a simple formula anybody could follow.
Okay. This is our last question before we wrap up this show. If people don't have a credit score or they lack a credit history, what are ways to solve that if they're looking? Like, I'm thinking about my mother-in-law in particular. Like, she is in her 60s and never opened a credit card. So
good luck convincing her.
Well, she won't. She's done. But there are people who have that profile and are younger who might be interested in building a credit history. What does that person do?
Absolutely. So firstly, just by living in the United States, we all get 1 free credit report a year from annualfreecreditreport.com. Now, this won't give you the scores unless you pay for it, but it will allow you to pull all 3 of the credit reports. But why I really like that site is if you don't have any history and you haven't done anything in a while, just by pulling it from that site, it'll update all of your information to the most current on the back end. Okay. I'm usually not a fan of loopholes. I like to build things on solid ground, but if you want to pull your credit report and get an accurate score to where it won't be a hard inquiry where you're applying for something you can get approved or denied for, you can go on privacyguard.com, you can go on identityiq.com, you can go on even Experian.com, you can pull your credit report for $1. They usually have a trial period for about 7 to 14 days. Cancel it before the trial period. Now you have access to the report for 30 days. And then I would talk to the most trusted person closest to you. So your mother, your grandmother, see anybody who does have a long credit history, see if they will add you on their card as what you call an authorized user. Don't take the card yourself, okay, because that way you don't have to deal with any of the liability, but use that as a leg up to then incorporate your own credit cards.
And essentially what happens there is their activity as a credit user is impacting you.
Absolutely. So if your grandmother has excellent credit for 25 years and she doesn't let anybody mess with it, she might not even let you on it. But if she puts you on the card, you now inherit all of that history and all the payment benefits that she's had. And then I, again, call it an artificial way to inflate your scores, because if that's the only positive account you have on your profile and then you have other negative things on there, you won't qualify for a mortgage. You can go finance a house, a car, furniture, and other small ticket items. But overall, if you want a quick leg up, find someone within your family or that you trust. I've been in this business 8 years. You would think I was a marriage counselor, because even though couples say they have a good buddy system, when credit cards come in line, it becomes a different story. So I would just be careful with that, but then otherwise seek out, someone who knows what they're doing, ask them to teach you the right steps to take, and then follow those steps. You don't necessarily have to subscribe to the program that they're doing. If by sheer will of just their consultation, you don't get enough information that allows you to build it on your own, that's the mark I would use to find a different option for yourself.
Indeed. Reverly Carter is not letting me on her credit card, riding her coattails. But anyway, this was an excellent conversation with Mr. Momodou Mambouray, CEO of Max Credit Score. Thank you for being on the show, sir.
Thank you, fellas. Thank you.
Indeed. Well, I want to remind folks.
Thank you, Senator.
Right.
Don't
My
put
bad.
that pressure on me,
Congressman.
I love serving people, but just from the real way.
You're well on your way, sir. Well, anyway, I want to remind people you can catch past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Of course, please leave us a review on any of those platforms. That helps more people catch the show. If you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. Of course, you can always catch us on social media. My handle's @MYDM1. Malcolm, what's yours?
@Malcolm on Money.
And because you're sitting here, what's your handle?
You can follow us at Max Credit Score. That's on Instagram and Facebook, and also on Instagram @_Mandinka King. Follow at Max Credit Score. You'll find the rest of our pages there. Thank you.
Indeed. And then, of course, thanks to our partners here at Montgomery Community Media once again for their wonderful hospitality. Until next time, be good with your money.
Peace.
Peace.